Yeah, I think for Q4 2018, the estimates have been cut already. But what is even more important is, of course, what will happen in 2019. And the overall big theme, or one of the key major drivers in 2019, from a top-down perspective, in our view, will be a further slowdown in global growth, a further loss of momentum. And against that background, it's not surprising that earnings analysts have cut their and downscaled their estimates for earnings already in the US. So we will probably still see earnings in the mid-single-digit range in the US, against the background of our expectation of growth in the US that is slowing down, but probably still at or slightly above potential. When we look at the Eurozone, the earnings estimates of the mid-single digits seem to be fair, but there might be some further downgrades in the Eurozone there.
It appears to be an outlier at this moment, but what are the risks that we actually start to see maybe some of the inflation numbers coming in a little stronger than expectations? I mean, the numbers flatter to deceive because we had headline inflation here in the UK, which people said, oh, look, inflation's abating. But actually the core was still quite strong if you X'd out the oil effect. So is there a risk that as we see salaries increase and input costs increase, actually companies may be able to pass that straight through? We've seen companies like Apple and Netflix that we're talking about this morning lift prices on expectation of higher input costs. Maybe they can hold the line on profit and margin.
It's a very interesting point that you're mentioning. It's this ambiguous inflation outlook that we see. The inflation outlook has become less clear-cut because on the one hand, as you mentioned, given ever tighter labor markets, we see this pickup in growth. And in our view, the Phillips curve is clearly not dead, it's still alive. On the other hand, given the oil price moves, we've seen this depression in inflation rates, and this will probably continue throughout the year. So one of the reasons why the market's expectation when it comes to monetary policy have become a bit more dovish. But you're right, you want in this environment, you would still want to look for companies that are able to pass on these higher wage costs and input costs that are lingering in the background.
At the beginning of the year, analysts, investors are looking at guidance as well, especially full year guidance. Do you think against this really uncertain backdrop, Brexit, trade wars, etc., that CEOs are less willing now to give guidance?
To give guidance on their earnings?
On their earnings, say, for the full year, to really portray a sense of visibility against this backdrop of uncertainty.
Yeah, I think it's clear, given the more challenging backdrop, that they will definitely highlight uncertainty to those various factors. I would agree to that.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.